Hi, I'm Natalie Cook. I'm the CEO and owner of Finance Fight Club. Today, we're going to talk about what your financial statements are telling you in a little cheat sheet so that you can figure out which statement you need to read for when and for why and how and what it means. So if you are new to understanding financial statements or you need a refresher, probably check out this video. We do have a link in the comments for a little 2-pager financial cheat sheet that you can download and take with you and pin it up next to your, I don't know. I don't know that everyone's going to want this next to their desk, but hopefully on your desk so that when you are reading your financial statements, you can say, oh, yes, this is what it is going to tell me. So I hope that you're going to take away from this video what your P&L, balance sheet, and cash flow are going to tell you, what KPIs you can get from them, and just understand a little bit more. So this matters for a couple of reasons. Your financial statements are your business scorecard. Now, of course, you're going to manage a different KPI dashboard, which are your key performance indicators, and you're going to have financial and non-financial KPIs. And if that went way over your head, that's okay. We'll have a KPI video coming soon. The point of this is to make informed, data-driven decisions for your business to push your growth forward. A lot of people use their gut to make decisions in their business, and a lot of people are very good at that. There's nothing wrong with that. I like a combination of both, but I will tell you in my experience, humans really think they are better with numbers than they are, meaning they track a lot of things in their head, and then they look, they're like, wow, that was wrong. I was very wrong on that. So just so you know, whatever you think is happening, let's say you have $100 in your bank account and you're like, I'm not going to overspend. I've got this, this, and this. I tell you, unless you're writing it down, you're going to just not pay attention. Like something's going to fall through the cracks. It just happens. It's how we are. So this is your guide to stop feeling overwhelmed by those numbers. Financial statements feel complex until you read them. Now, I don't quite know what that's like anymore because I've been reading them for so long that to me, that's just like a second language. But I do know that you can get there where the financial statements make sense to you, especially when it's your business. It's very easy when it's your business to be like, that's what happened. Okay, this is what I need to take away. So don't be scared. You can get there. There's a couple keys to success when you're managing financial statements that I want you to keep in mind. One is you need to keep them updated monthly. So if you don't do monthly bookkeeping, if you're thinking, well, we're just on quarterly because that's all we need for taxes, I guarantee you're missing opportunities to make more money in your business, to save, to put things aside, to maybe do some things that'll avoid some taxes. Just keep them updated monthly. Just do it. There's lots of good bookkeepers that will do that. Please don't do it quarterly or annually. You will find mistakes that you can't catch and it will be more costly. Set aside time to review all 3 of your statements. So if you don't have a fractional CFO, if you don't have a finance team, if you don't have a finance director on your team and it's you and a small team and there's no finance oversight of someone who is reading all of those every month, block an hour with you and your leadership team or whoever needs to be on it and review all 3 statements. And there's a questionnaire. I don't have it developed, but I have one. This is what it should look like. This is the questions we're going to ask on the P&L and the balance sheet and the cash flow. And it's a yes, no, is everything right? So at the very least, start reviewing it monthly. I guarantee you by month 5, you're going to have a no-brainer. Wow, that's miscategorized. Oh, why did we spend that? I didn't know this was happening. And you're going to find money that was just going out the door before. Number 3, set targets and measure progress. So this is really important. And this is something that you need when a fractional CFO comes on board and you're just not going to get there on your own. Wow, there's a lot of notifications coming on. Hold on. Let me pause my do not disturb. Okay. All right. Sorry, let me go back to this. So number 3, set targets to measure your progress. This is something that if you don't have a fractional CFO or you don't have a finance person in your business or maybe an operations director or just the right executive that's saying, hey, this is how we're going to measure progress, you need that in your business. It might be one of 3 different people, but that's something that's really important to know, especially if you have really big goals. You just aren't going to get there without setting targets and measuring against them. It can be very simple. Hey, we want to get to $100,000 of revenue. How are we doing with that? What's going on? Why or why not? It could be, hey, we want to serve 100 customers. So it doesn't have to be something that pulls from your P&L. Again, you're going to have both of those married together, and then you're going to have a really, really solid understanding of what success looks like. Number 4, be super consistent with your approach. If you're just getting into building this financial foundation for your business and you aren't doing monthly bookkeeping and you haven't really tracked it, make sure that's consistent. So track expenses consistently. So all your office expenses, make sure they go in office expenses. All your software, make sure they go in software and they're categorized correctly and you're being consistent, because that consistency over time will build and then you'll be able to have a lot more insights into your business. And lastly, seek expert advice when you're struggling. Just don't struggle on your own. There's so many people that are willing to help. There's So many resources out there. Just get help. If you're confused, get help. All right, so first we're going to talk about statement number 1, and that is the profit and loss, also called the income statement. Profit and loss names itself, right? It is what's your revenue coming in and your expenses going out. So it's showing you if you've made a profit or a loss at the end of the day. That's the bottom line number on your profit and loss. Is that, did you make a profit or did you lose money? It's also called an income statement. Not everything is on the profit and loss. So I think this is one of the things that really confuses people. If you are, say, an owner that takes an owner's draws, you're a pass-through entity, a lot of the dollars going out are not going to show up on the profit and loss. So you can look very profitable. Oh, we made $100,000, which if you took $100,000 out of your business to pay yourself, you kind of have to calculate that in. The structure of this one is revenue and sales at the top. You want your fixed and variable costs underneath. So sometimes that's cost of goods sold, your operating expenses. Where did you spend all the money that you made? End of story. You might have taxes, interest expense. The margins that you're going to understand from this sheet are your gross margin, which is your revenue minus your cost of goods sold, your net margin, which is your revenue minus all of your other expenses, your EBITDA, which is your earnings before interest, taxes, depreciation, and amortization, which is marketing, not a marketing expense. It's marketing for finance. And then you're going to see your operating margin and your contribution margin on this sheet. And we could have other videos going deep dives into what those margins are, but that's the core of your profit and loss. Now, there's going to be some KPIs that you're going to pull from your profit and loss, and you're going to want to put onto a KPI dashboard somewhere. And from the profit and loss, you're going to see your gross revenue, your gross profit, your net profit, your EBITDA, expenses as percent of revenue, any of those expenses as percent of revenue are really, really helpful over time. They may not be completely applicable. One of my portfolio companies that we're working with right now, we are heavily tracking labor as a percent of revenue and seeing if we can trend it down slightly. But really that means pushing revenue up and keeping labor as is. It really isn't about, it's getting a little more efficient in labor, but it's really pushing that revenue up while labor stays the same. So just know that it can mean a lot of different things. The key to success with managing your P&L are consistent revenue streams. So categorize your revenue streams very consistently year over year, month over month. If you have 3 ways that you make revenue, make sure they're all categorized. Sometimes people lump it all into one revenue. As long as you have another database where you can track, that's great. But the key is to know the margins for each of those revenue lines and know what's working and what's not working, because a lot of times when people lump everything into one line of revenue, they're missing opportunities to be more efficient in their business, or they're missing opportunities to raise prices, cut a service or a scope of work that's not performing well, get rid of customers that aren't performing well, those types of things. So the more consistency you can build, the better. The other piece is one of the things that I look at with clients when we're looking at their streams of revenue, and we may not do this on a monthly basis, it might be a quarterly or an annual area that we look into, but is there a product or service that's over 25% of revenue? Is there a customer that's generating over 25% of revenue? And is there a product or service that's generating less than 5% of revenue? Or a customer customers often generate less than 5%, but the goal there is just to make sure that you're not basically putting all your eggs in one basket. If you have one customer that generates 80% of your revenue, and that's a risk that you are being treated as an employee when you're not, or you could be, there's some other legal issues to that. The other piece of it is, what if that customer cuts you and you lose 80% of your revenue because of it? So it's a risk association. It's not necessarily you're doing anything wrong, but something to keep an eye on. And the other one is, you don't want your expenses to grow faster than revenue. Now, there's going to be times where your expenses are going to go up and your revenue is not going to kind of track it, but revenue doesn't go up. This is probably backwards, but I don't know. Revenue doesn't go up in this way all the time. It's very lumpy often. It's very like, hey, we're going to go up and over and up and over. And expenses might go up and over and up and over, but you don't want your expenses to outpace your revenue over a period of time. That's the profit and loss. That was a lot of information. I feel like I talked very quickly. But again, download the cheat sheet, and that's going to give you these things kind of broken out, and you can get really familiar with your specific profit and loss. And then it's going to become really clean and clear what to look at. Now, The second statement, this is the most confusing to business owners who are not financially savvy, and it's the one that is most incorrect. So if I'm going to look at a client's or potential client's financial statements, we always ask for both the profit and loss and a balance sheet, primarily to see what their bookkeeping is like. I can usually tell by looking at a balance sheet as their does their bookkeeper know what they're doing? Are they actually providing the right data? What's going on? So I like to think of a balance sheet as kind of your business's net worth calculator. Now, it's not exactly the same, but if you've ever done a personal net worth calculation for your personal net worth, you're saying, hey, these are all our assets and these are all our liabilities. And then you're deducting that and saying, okay, that's what we have in net worth. So if I own $1 million of real estate, but I owe 600,000 on it, my net worth is 400,000. Balance sheet is similar. It's a point in time view of your business. And it's going to show you your assets and your liabilities and your equity, and your liabilities and your equity equal your assets. That's the overview on a balance sheet. Now, that's telling you is a different thing, right? So your asset, what your business owns, which is your cash, your equipment, your accounts receivable that you're waiting to receive, anything else the business owns. Liabilities is what your business owes. So this is a lot of times your tax liabilities, your payroll taxes, your credit card, your debt. And then the equity is the amount that the business owns outside of that. What are the KPIs going with this? So there's your current ratio. This is your current assets divided by your current liabilities. It's kind of showing you how quickly you can pay off your debts. Do you have cash in the business? You've got your debt to equity ratio, your total liabilities divided by shareholders equity. That's just a ratio. That can be wildly different depending on type of business. That's more of a business strategy. If you're in a particular type of business, that might be more key. If you're privately held, that's going to be all over the place. Working capital is a big one. So current assets minus your current liabilities. Now, this is just telling you your point in time. I think I made a video on working capital. If not, I have to redo it. That's a big one, but your balance sheet's just showing you like an accurate, like, hey, did your current liabilities cover, or your current assets cover your liabilities? Can you cover it? How many times can you cover it? So big things with your balance sheet that you want to look out for if you're the owner every month. And this is regardless of whether you have a CFO or a bookkeeper or whatever, you should just check this. It could be 2 seconds. Make sure your cash balance matches your bank statements. So your bookkeepers should be reconciling to your bank statements. So on October 31st, the balance in my checking account should match the balance of my checking account on my balance sheet. That's what I'm saying with that. Make sure that your debts match the debt and that your bookkeepers are drawing down debt as you're paying it back. Same with your credit cards. You want to make sure that you have more assets than you have liabilities. Other way around, you are about to lose your business. Those are the big things on a balance sheet. Now, I've seen all sorts of wonky stuff on a balance sheet. Cap tables get really confusing. Everything gets really confusing. So if you are confused, please reach out. I'd be happy to take a look. But that is the number one thing where there are issues, and it's really expensive to clean those up. So stay on top of it. Lastly, I'm tired. This video is wearing me out. So energy-wise. Okay, the last one is your cash flow statement. This is just showing you how money is coming in and out of your business. Saying in the month of October, I made $1 million. I spent $800. And where did all that money come and go? Or actually, it's not even you made $1 million. It could be $1 million came into your bank account. Maybe you got debt funding and revenue, and it came in and you spent $800,000. The difference here is that when you are looking at your profit and loss, it's not capturing all your cash ins and outs. It's capturing that month of time where the revenue and the expenses went. Now, a lot of times where people get confused, and again, this is not for this video. This is in depth, people. I cannot do all this in one video. What gets really confusing is if you are in cash-based accounting versus accrual, you may not understand that profit and loss does not follow cash and cash flow does. Because when you're on cash basis, they look pretty similar. You're not really holding on to a lot of accounts receivable, or you're not accruing all of this revenue that then you're duplicating over time. So your profit and loss shows your revenue that came in that month and your expenses that went out in that month. And that's okay. As long as you know what's going on, that's important. But your cash flow can be very insightful, especially if you're accrual-based accounting, then your cash flow is almost more important than your P&L. Your P&L is a lot more for reporting purposes and your cash flow is a lot for managing purposes. Oof, I need a breath. Okay. So your cash flow forecast can be daily, weekly, monthly, quarterly, annual. You should not be managing it annually, but I would recommend that if you are on, hey, I have to manage my cash flow weekly, we need to make some steps so that you can kind of breathe and know that you're covered over the month and that you're just touching base weekly, but you're not like stressing about getting from Monday to Friday without cash. That's a bad sign. Monthly would be great. A 13-week cash flow projection will kind of cure a lot of that. And you'll just be like, yep, it's handled. It's good. We've got some buffer. And then we can kind of move on. The key KPIs that you want to pull from a cash flow statement is your net change in cash. So how does the net change in cash show over a period of time? Usually monthly is what I'm looking for, might be weekly. Your ending cash position, this is a great one to look at monthly, but quarterly is a great metric for this. And the meaning, it just means like monthly can be off, but quarterly might show a little bit more of that seasonality of the business. Your operating cash flow. So this is the money that you need to operate the business versus like investing cash flows, which is like maybe you're using a portion of your money to invest in a capital expense, but you don't need it for daily operations. Financing cash flows, maybe you're taking on some debt. So you're servicing debt or maybe taking on a little bit more debt. Operating cash flows is really like, hey, if we got rid of all this debt, we didn't have extra expenses, what's the cost of running the business? I feel like this kind of goes without saying, but the consistency for it, the key to success for a cash flow statement is to consistently generate more cash flows than inflows than outflows. You want more cash coming in than going out. That is the key to life, right? Then you have cash left over and you can build cash reserves and you can follow me along on that journey. So we reviewed a lot today. I'm really tired. I think I need a nap after this video. Download my cheat sheet, your stuff together, book some time on your calendar to just review those statements and follow my cheat sheet. All right. Have a great day. I'm tired. I don't even have a goodbye. So bye.